Back with First Rates right here on ET Now. Sanjay Sethi is Managing Director and CEO at Chalet Hotels, and he now joins us on the show. Thanks so much for taking time out, Mr. Sethi. Avan this side. I just wanted to start off by talking about the upcoming season, because generally and seasonally Q2 is a bit weak, but owing to events like G20, the Men's ODI World Cup, even the start of events, and the fact that we've seen the number of inbound international travelers seeing a bump up compared to pre-COVID levels, is that what you're experiencing on ground, an influx of demand?
Good morning, Avan. Yes, very much so. I think we're certainly banking very heavily on the increase in foreign inbound travel, whilst domestic business travel has been extremely strong for the last few quarters. So we do expect quarter 3 and quarter 4 to be pumped up significantly on account of international inbound business travel. G20, the World Cup, etc., is actually technically in Q3, a month-long event, but that's not going to be the long-term story for Indian hospitality. The long-term story for Indian hospitality is going to ride on the massive gap between demand and supply, and therefore we see a good run for the next few years.
When do you think the supply-demand gap will meet? Because just about everybody is looking at expanding, and they're looking at expanding massively. So a lot of capacity perhaps will kick in next 2-3 years, I would imagine.
Hi, Nikunj. Look, yes, everyone's looking at expanding, but it's what really matters is expansion on the developer side, which is going to add capacity. Someone has to build those hotels for a capacity addition to happen. The asset-light expansion that you're seeing is a large amount of expansion into tier 2 and tier 3 markets, where a lot of unbranded hotels are now getting branded, and some new ones are being built. In tier 1 markets, it's not easy to build new hotels. And therefore, we're very confident that the supply will remain muted for the foreseeable future. And when I say foreseeable future, I'm talking about the next 4 years. And therefore, we will ride that rate of very high rates and very good occupancies for the next foreseeable future of 4 years at least.
If I could just take that point forward, because your model is a little different, right? While the industry peers are focusing on asset-light expansion route, you've chosen to grow the hotel room and office rental portfolio over FY23 to 27 through the ownership route. Tell me, how is this strategy or differentiated strategy working out for you?
So, Avan, there are a couple of things in this. While our, hedging the risk has happened through asset quality or asset classes differentiation, where we've got some office assets in addition to hospitality. We are also very bullish on the brick and mortar business in the hospitality business doing extremely well going forward. Look, the returns are extremely healthy. You are able to hit about 40-50% EBITDA, depending on which cycle you look at. And the returns are now stabilizing closer to the 20% mark, which is a healthy return by any measure. On the asset-light strategy, what happens, and the reason we don't want to go down that route is because it'll take 20-30 years to really get to where some of the companies are. But at the same time, every hotel that we add to our portfolio, and it could be just 1 or 2 hotels a year, brings in about 50 to 70 crores of EBITDA to the balance sheet, which is really large. Compare that with the asset-light strategy of many brands. Brands will have to add about 30-40 hotels a year to really look at doubling their current EBITDAs in the next 10 years' time. So we believe our strategy works for us, given our strengths, our positioning, and what we bring as value to the table.
Okay, clearly that's the route that you're saying works for the company. So in light of that, take us through how things are shaping up in terms of your new projects, the Delhi airport, the updates on the expansion of Novotel Pune, the Duke's Retreat, the refurbishment, etc. on that front. What does all of that do to your headline number?
Sure. So we've got roughly around 1,000 rooms under development as we speak. The Pune one is ready. We got the OC last week. We should start operating that from end of this week or early next week. Delhi is work in progress. We expect to, as shared earlier, commission that sometime in quarter 3 of FY26, so which is the October to December 22 quarter. The Hyatt Regency in Airoli is a 280-room hotel, which should start having shovels in the ground on that one sometime in the next 1 or 2 quarters. And we should be completing that in about 24 months from then. In addition to that, we've got 130 rooms additional coming up at our Bangalore hotel. We've got Dukes expanding, renovating and expanding, and then repositioning itself to the upper upscale segment, where we should complete the renovations in the next 8 to 9 months' time. So we are all in all extremely excited about the progress that we have. We've got a couple of other projects that we can potentially look at going forward. This is also driven in confidence by the improvement on the EBITDA margins and EBITDA numbers, which gives us a lot of comfort, especially the last few quarters, has given a lot of comfort on the balance sheet side of the business, where we see potentially a lot of headroom coming in from our balance sheet side for growth in the future.
What is happening to business travel specifically? Because that's the sensitive part. Very price conscious. It is a function of what happens to the economy, not happens to the addition of availability of rooms.
Sorry, Nikunj, I missed the first few words. It happens once in a while.
Business travel specifically, because that's a very price sensitive market and that's a very price sensitive category.
Well, it isn't. It's a lot more elastic than we think it is. We've seen that happen in the last 4 quarters. The average room rates for our portfolio alone are up 38% compared to the previous year. And they're significantly higher than FY20 numbers, indicating that the business traveler today has per diems which are far higher than they were ever. And therefore, there is an elasticity on that side too. Our assessment is that we've managed to get about 25% growth this year compared to last year on the business travel contracts. We expect that to grow in double digit year on year for the next 2 years at least.
So as of now, if you have to, let's say, talk about next 2 to 3 quarters, if you have to, let's say, give a guidance for Chalet and for the hotel industry, you are confident and you are reasonably certain that the trajectory for occupancy and rates is actually higher, not lower.
In fact, quarter 3 and quarter 4 will definitely outperform 1 and 2. And by quite a margin. Remember, H2 is always a lot stronger than H1 for the industry. And H2, we expect it to outperform H2 of last year by, again, a fair amount of comfort. I mean, I would be surprised if the industry-wide growth in H2 is not in 20% all India basis.
And when one has to, let's say, go beyond 2 quarters, the effect of, let's say, G20 or Cricket World Cup, these are one-time events. It may not actually occur again. So do you see that, okay, these 2 quarters, great, but then when you roll over to the next calendar year, next financial year, there could be normalization?
Yes and no. Look, Chalet didn't have any major events of G20 and World Cups, having with us. All our growth has come out of regular, sustainable business and through our very solid segments of domestic and international business travel and the MICE segments. And there's really nothing that was significant, which is out of the normal for us. So our growth on the basis of this year's numbers will continue for the future, for the next year or 2.
Okay, good to have you on board. Sounding very optimistic. So perhaps we'll connect with you then, post the quarterly numbers and get in a sense as to what the future up ahead even holds for Chalet Hotels.
Thank you.